Hey guys, what's up? Making a quick video on ATR, the average true range. Let's get into it. It'll be quick and sweet. So basically, what is ATR, right? So the ATR is the average true range. What does that mean? It's basically a measure of the average movement going on in the specific symbol that you're trading or the specific ticker. So let's say right now we have ES up, right? So the ES is moving between 9.25 points and 594. And 5.94 points. That's the range it's currently in, and it's measured by this red line, right? So the ATR is kind of like a heart monitor. The wider the range, the more volatile the stock, right? And then, as you can see, it starts kind of dying off, and we'll briefly touch on that. But basically, how would you use ATR? So ATR, the way I use it is I gauge how our movement is doing, so I can properly gauge risk management, right? So if we're moving in a 2-point range, it makes no sense for me to have a 0.50 stop, for example, right? Because more than likely, the very next candle is going to take me out. And I'll give you guys an example of a few trades I took today that kind of like messed me up because I wasn't gauging with the ATR. But yeah, so ATR, average true range. TradingView has a pretty good one, good indicator. You just type in ATR to give you TradingView's version. Basically, it'll pop it up here like an RSI chart almost, and it'll show you the ranges, right? So an example here would be, we can replay this. So this was this morning's ATR. So this was pre-market. So pre-market, before we had our CPI print, right, we were ranging between 228 and 144. So what does that mean? It means that every 2-minute candle was in a range between 2 points and 1.4 points. So usually when I'm trading, I use a 8 to 9 tick stop loss, and I take a 16 tick profit. So usually that's about a 2-point risk for a 4-point reward, right? That works here because the volatility isn't crazy, right? We got some candles like there's a 4-point candle, but if you're using a 2-point stop, you should be fine. So that's the range that we were trading in. So if you're taking trades pre-market, you know that you should keep your stop loss somewhere close to the range, right? So if you enter a trade, you probably want to keep a stop between 1.5 to 2 points because you know that's the average is moving in, right? Now, here we get an explosive move, right? And obviously it's going to skew the range a bit, but we get an explosive move. So now the candles are moving way past, they're moving way past, 228 and 144. So instead of moving 2 points or 1.5 points, we are now in a range where the candles after that big explosion were moving between 9 points and 5 points. So what does that mean? It means that the average candle move was between that range. What does this mean for risk management? It means that our stop losses cannot be that tight anymore because every candle is in a wider range, right? So if you're using a 2-point stop loss, more than likely you're going to get wicked out a whole bunch of times before the trade goes in your direction, just due to how crazy the range is moving. And I'll give you guys an example, right? So at 10:31, I noticed this forming here, right? So we're bouncing off of, we were hammering off of a support level that I had drawn here. This level broke down and it kind of started getting bought up. On the book map, I saw there was a lot of liquidity there, right? So I was like, all right, hell yeah, it's an easy play here. Let me go long. So I'm gonna mark my exact entry, right? So my entry was 40.8650. The problem was that I didn't adjust my stop losses from pre-market, right? So my stop was 225. It was 9 ticks, which fantastic. When the range is 2 points, that's a valid stop loss, right? I'm giving myself some good wiggle room, right? My target was going to be the 12 EMA right up here. The problem is that since our average true range is way wider than it was pre-market, I kept getting wicked out. And I'm not going to lie to you guys, I took 4 trades in these 2 candles because I kept getting stopped out. And I'm like, yo, what the hell's going on? So I got wicked out here, I got wicked out here, and finally, the candle was already moving when I finally did get a good play. But I adjusted my stop, I made it wider, So I gave it 15 ticks, right? And I managed to take this little trade here. So I got in, I got out around here at around 40.9650. So I took a little 4.5 point move for me, right? But my original entry was 40.8650. So if I was using the ATR from the get, right, and I saw that it was increased, that it was where it was, I could have easily just adjusted the stop, right? The average range right now is between 925 and 594. So a 4 point stop isn't too unrealistic, right? I'm giving it some wiggle room to run. I don't want to take a massive loss, and I'm giving it almost an entire candle stop based on the ATR, right? And then the take profit would have been there. So that trade looks way more favorable than the other one I took, right? And yeah, that's basically a quick summary. So the ATR, we want to use it because it gives us the ranges and it gives us kind of a gauge of what we need to be doing, right? So if the volatility is higher, right, the average two range is way bigger, you might want to size down and allow a larger drawdown so you can make profit, right? Because your profits are going to be exaggerated as well as the loss, right? Pre-market, the most we were moving was about 2 points. There's some candles here that are moving 9, 12 points because the range is expanded. So that's the way I use ATR. And the other way I use ATR, very simple, is that I see when the drop off happens. And based on data that I've compiled for the last like month and a half, usually we'll peak out around 10:30. So 10:30, 10:40ish is when we'll be at the most volatile. That means the candles are the widest. That means that most of the plays you take are going to have the best follow through. After 10:30 to 11, the ATR starts dropping. So what does that mean? We start getting chopped up. The setup's probability starts going down. They don't justify the risk we're putting on to get a move, right? And you can see here we got some movement, but the candles are now smaller, right? You can see the ATR just falling off. So we went from moving around an average of 9 points a candle. We're free falling here to around 586, which, even though, like, for example, this drop is fantastic, right? But you would have to eat these little candles. That might mess with you guys' trailing drawdowns if you have any. So that's another way I use ATR. I use it to gauge on the volatility, right? Usually around 10:30 to 11 o'clock, volatility is gone and it comes back at around 1:30. And then if you can see, right, here's our ATR now. So throughout the day, the volatility is just getting plunged, right? So ATR went from 524, 594, broke that. Now we're moving at an average of 5 points a candle, which is not bad. But now would be the time to, tighten your stops again and be very particular with your setups because it's starting to chop around. And that's basically it. Any questions, concerns, let me know. There's a quick video I made intraday on ATR. So just to summarize, ATR, average to range, it gives you the measurement of how wide the candles are moving. We use this one to gauge risk, right? So how much risk do I have to take to make profit? So it helps you gauge how much profit you can make, how much risk you got to take. And it also gauges when trading activity is slowing down, which we saw earlier with that decline at 10:38, from 10:38 down to 11:44. And that's about it. Catch you guys on the flip side.